Investment funds. What is an investment fund? An investment fund is a form of investing money in various portfolios managed by a bank or another financial institution. This type of investment requires the client to select from a group of funds with a suitable level of risk, investment time horizon, and liquidity. These funds typically invest in bonds or stocks. Bond funds are associated with low risk, while stocks entail significantly higher risk. Mixed funds, investing in both instruments, are also available. Additionally, we can make a more specific choice, for example, by investing in a fund focused on stocks from a particular country like Poland, the USA, or regions like Asia, Europe, etc. By contributing money to the fund, we become partial owners, and our funds grow or decline along with the movement of prices of financial instruments purchased by the fund. All funds have so-called management fees, which we pay when buying into the fund, realizing profits, and withdrawing funds. Investment fund versus the broad market. It is a fact that investing in stocks is challenging, and even groups of experts often achieve results worse than the broad market. For example, a fund investing in precisely selected stocks from the United States often yields lower profits than the country's index, such as the S&P 500. Often, aggressive funds, such as hedge funds, also incur significant losses by increasing the level of risk by shorting stocks, which is riskier as, in the long term, the vast majority of stocks rise. Weak fund results stem mainly from two reasons. Firstly, the experts working in investment analysis departments often use outdated methods and valuation formulas for stocks. Knowledge taught at universities often relies on normative economics, which poorly reflects market realities and, according to many, should not be forgotten after 2008, when the money printing first introduced significant unnatural disparities in the stock market. The constantly increasing number of retail players associated with newly available trading technology through smartphones and the widely popular stock market game increasingly affects market irrationality. Secondly, where are the client's yachts? This saying points to the goal behind funds. Their main objective is to enrich themselves rather than the client. Apart from purely illegal plays by funds, a significant portion of profits is taken through fees and commissions. Thus, it is often better to invest in an index than to rely on the expertise of fund managers, which not only fail to outperform the broad market, but also incur additional fees. Investment fund and the stomach issue. When investing in the stock market through an investment fund, we entrust professionals with selecting and composing an appropriate investment portfolio with stocks from a specific sector, for example, U.S. stocks. The financial markets widely discuss the role of the mind and stomach. The mind is responsible for analyzing and selecting stocks, while the stomach refers to the behavioral sphere of investing. According to many investors, the stomach is the more critical tool because it is responsible for the biggest pitfalls such as fear or greed of the investor. By investing through a fund, we still remain alone with our emotions, and many people let them get the better of them, investing at the worst times and withdrawing funds at the so-called bottoms. The COT, Commitment of Traders report, indicates significant fear among retail investors in the face of the Black Swan event, which was the COVID-19 pandemic, a 35% drop in the broad U.S. market. The chart plummeted, reaching a total of retail player positions, minus 60,000 positions, which were acquired by institutions. As we learned over time from the pandemic lows to now, i.e. January 2022, the S&P rose by over 120%. On average, this index grows by 10% annually. Therefore, being a fund holder does not protect us from irrational behavior from the perspective of a stock market investor, even though we only have access to two actions, namely depositing and withdrawing funds from the fund. Types of investment funds. Investment funds, also known as mutual funds or collective investment schemes, offer investors a convenient and diversified way to invest in financial markets. These funds pool money from multiple investors and invest in a variety of assets, managed by professional fund managers. There are several types of investment funds, each catering to different investment objectives, risk appetites, and preferences. Here are some common types of investment funds. Equity funds. Equity funds, also known as stock funds, primarily invest in stocks or shares of publicly traded companies. These funds aim to provide capital appreciation over the long term by investing in companies with growth potential. Equity funds may focus on specific sectors such as technology, healthcare, or energy, or they may have a diversified portfolio across various industries and market capitalizations. Bond funds. Bond funds invest in fixed income securities, such as government bonds, corporate bonds, and municipal bonds. These funds aim to generate income for investors through interest payments while preserving capital. Bond funds may vary in terms of duration, credit quality, and geographical focus. They offer investors exposure to different segments of the bond market and can be suitable for income-oriented investors seeking regular payouts. Balanced funds. Balanced funds, also known as hybrid funds, invest in a mix of stocks and bonds to achieve a balance between growth and income. These funds typically maintain a predetermined asset allocation, with a portion of the portfolio allocated to equities for capital appreciation and another portion allocated to bonds for income generation and capital preservation. Balanced funds offer diversification benefits and are suitable for investors seeking a balanced approach to investing. Money market funds. Money market funds invest in short-term, low-risk securities such as treasury bills, certificates of deposit, CDs, and commercial paper. These funds aim to provide liquidity and capital preservation while generating modest returns. Money market funds are considered low-risk investments and are often used as a cash management tool or an alternative to traditional savings accounts. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500 or the C100. These funds invest in the same securities that comprise the index in the same proportions, thereby mirroring the index's returns. Index funds offer low-cost exposure to broad market segments and are popular among passive investors seeking market-like returns. Sector funds. Sector funds invest in companies operating within a specific industry or sector of the economy, such as technology, healthcare, or consumer staples. These funds provide targeted exposure to a particular sector, allowing investors to capitalize on industry-specific trends and opportunities. Sector funds may be more volatile than diversified funds due to their concentrated holdings, but can offer higher potential returns for investors with a bullish outlook on a particular sector. Real estate investment trusts, REITs. REITs are investment funds that own and operate income-generating real estate properties, such as office buildings, shopping malls, and apartment complexes. These funds allow investors to invest in real estate assets without directly owning the properties. REITs typically distribute the majority of their income as dividends to investors and offer exposure to the real estate market's potential for capital appreciation and rental income. In conclusion, investment funds offer a range of options for investors to achieve their financial goals, whether it be capital appreciation, income generation, or diversification. Next, let's talk about the difference between synthetic and physical funds. Physical funds. Physical funds, also known as traditional or direct funds, directly hold the assets they aim to track or invest in. For example, if it's an equity fund, it will actually own shares of the companies included in its portfolio. Similarly, if it's a bond fund, it will hold the bonds issued by governments or corporations. The value of the fund is directly tied to the performance of these underlying assets. Investors in physical funds have direct ownership of the assets held by the fund, and the fund's performance closely mirrors the performance of the assets it holds. Physical funds attributes. Safety. Physical funds are generally considered safer by many investors because they directly hold the underlying assets. This means that investors have actual ownership of the assets, providing transparency and security. Transparency. Since physical funds hold the actual assets, investors have visibility into the portfolio holdings, allowing them to assess the fund's risk exposure more accurately. Counterparty risk. Physical funds typically have lower counterparty risk compared to synthetic funds because they do not rely on derivative contracts with counterparties. Instead, they own the assets outright, reducing the risk of default by third parties. Risks may require additional expertise. Synthetic funds. Synthetic funds, on the other hand, do not directly hold the underlying assets. Instead, they use financial derivatives, such as swaps, options, or futures contracts to replicate the performance of the underlying assets. These derivatives are agreements whose value is derived from the performance of an underlying asset or index. Synthetic funds enter into these derivative contracts with counterparties, typically investment banks or financial institutions, to gain exposure to the desired assets. The fund's value is then determined by the performance of these derivative contracts rather than the actual ownership of the underlying assets. Synthetic funds attributes. Synthetic funds. Potential for leverage. Synthetic funds often use derivative contracts to gain exposure to assets, which can provide leverage. While leverage can amplify returns, it also increases risk, making synthetic funds potentially riskier than physical funds. Counterparty risk. Synthetic funds are exposed to counterparty risk since they rely on derivative contracts with counterparties. If the counterparty defaults or fails to fulfill its obligations, it could negatively impact the fund's performance. Complexity. Synthetic funds can be more complex than physical funds due to the use of derivatives. Understanding the fund's structure, including the terms of the derivative contracts and the associated IDPINs. In the case of a synthetic fund, the money invested by the fund can be used to enter into derivative contracts, such as swap agreements, futures contracts, options, or other derivative instruments with counterparties, who in turn may invest these funds in other assets or ventures. However, the objective of a synthetic fund is to replicate the performance of specific assets or indices without the need to physically own those assets. So they can buy some futures contracts or options using leverage and spend the rest of your money doing whatever they want, speculating on crypto or trading. Of course, that would be highly risky and unprofessional in my opinion, but it can happen. This is the main difference between synthetic and physical funds. In the case of physical funds, the money invested by the fund is actually used to purchase and hold specific assets, such as stocks or bonds. Whereas in the case of synthetic funds, these funds can be used to enter into derivative contracts, which aim to replicate the performance of those assets without actually owning them. In summary, the main difference between synthetic and physical funds is how they gain exposure to the assets they invest in. Physical funds directly hold the assets, while synthetic funds use derivative contracts to replicate the performance of the assets without owning them directly.